Hey, how's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. And today's topic, I want to discuss with you long-term financial planning and what you should really know about long-term financial planning. Now, individuals that call our office, they have a couple different goals in mind, and a lot of it has to do with not really understanding how to specifically obtain those goals through a financial planning process. So that's what we try to do. We try to help uncover, some of those needs. Some of the little tidbits that I could just tell you kind of when you're in your accumulation phase, or you're kind of towards that later years and you're in your retirement income phase, is consistency. Safe consistency will get you to the finish line, the retirement finish line, every single time consistently. How exactly could you get there safely and consistently? And it's just avoiding the negatives. If you look at financial publications, or you look at some of the top financial gurus out there, they're in the world, they always go after the same premise. And that premise is make sure that you reduce your negatives. Eliminate your negatives completely if you can. Make sure that you're gaining different things that will allow you to avoid certain taxation, things that will allow you to accumulate on a safe, consistent basis without any downward market losses. And that's one of the things that is so important to understand. Individuals back in the day, they were able to go and take their dollar amounts and throw it into 401k plans and IRA type contracts and accumulate. From 1980 through 2000, individuals saw over 1,000% growth in the market. Now, this kind of spoiled that mindset. It spoiled that mindset for the baby boomer, thinking that, if I place money into a bucket, into some sort of retirement bucket, or throw it into stocks or mutual funds, whatever that is, then my money should always be increasing, right? Because during their working years, they're seeing this great growth, great growth, great growth. Well, from 2000, 2001 going forward, the same individuals that maybe they were baby boomers that were looking to now pull out retirement income, they were pulling it out, and the market was no longer consistent. It was not on that long-term plan, that long-term horizon of just constant growth. So now when you're having a shift in market volatility, and it's not just you're not receiving that income growth guaranteed every single year, and you're trying to pull money out from that account, along with different types of fees and different types of strategies, or different types of negatives that could negatively hinder those retirement accounts. That's where you have this retirement turmoil, and everyone has this question mark of how exactly could I properly retire. If you're younger and you're looking to basically place into a plan, just by very simple strategies, there's certain ways on how you could avoid taxes later on. Make sure that the money that you're accumulating is going in there post-tax, meaning that after it accumulates and when it comes out, it's going to come to you in a tax-free manner. Inflation, something that's going to beat the pace of inflation, something that's not just a fixed account or something you're throwing your money underneath a mattress, but something that could actually give you some very good consistent growth without any of the downward market losses. So you have the inflation. You want to make sure that you're beating that pace of inflation, which is the cost of goods that are increasing year by year. How exactly can we do that successfully? How exactly can we make sure that you're having the most favorable tax-free income type strategies in that accumulation process? The other one would be market. Avoid market loss altogether. There's certain strategies, and it all kind of depends upon your specific age or specific goals when you're looking to pull out retirement income, but there's certain ways on how you could avoid downward market losses. And like just a very simple concept is something known as an indexing strategy that gives you a floor of 0% whenever the market crashes, and then you could have high caps in a given year, as well, and have high growth within your account, whenever the market goes up. So, it's just basically that safe, consistent aspect with the no downward market loss that could already eliminate two separate factors of your overall retirement goal. And then the very last section is expenses, making sure that you're not paying minuscule or just meaningless expenses if there's no pure benefit for that specific product line, financial product or strategy. What do I mean by that? Well, what happens is we deal with both the beginning stage for those individuals that are looking to accumulate their money, and then we deal a lot with retirees that are looking for that preservation, that end of the rainbow of saying, you know what, I only have a couple years left for retirement. I've already accumulated this bucket. Now I want to start taking this bucket out, taking out the distributions in a very safe, consistent manner, distributions that I can never outlive. Well, majority of the times, those retirees, those baby boomers that are looking to utilize retirement plans, they fall victim to something known as reverse dollar cost averaging. So reverse dollar cost averaging, this is something that hinders retirement accounts, not allowing somebody to properly retire. it deals with mutual fund related fees. Okay? If you have a constant mutual fund related fee in your retirement accounts of 1% and the market doesn't gain anything, well, you'll still be having a negative of 1%. An advisor, a lot of time advisors, they'll charge you a wrap fee or something known as an advisor fee. On average, it'll probably be about 1.4%, but let's just say if we're utilizing a 1% situation, you have the mutual fund related fee, you have the advisor fee. Downward market loss. Even though these individuals that were experiencing from 1980 through 2000, the 1,000% growth in the market, it did not matter how much that bucket grew. You have some accounts that went from $1 million all the way down to $300,000 that 1 year after that 2008 market crash. And it was because of these different factors of not having that preservation, not having that safety net, avoiding that downward market loss potential. And then the very last negative is the income. When you're pulling out money from an account, obviously that's going to reduce that account dollar for dollar. So if you're pulling out money, and let's say in that given year you had a 10% loss, you had the advisor fee of 1%, the mutual fund related fee of 1%. If you pulled out 4%, if you had $1 million, you pulled out 4%, which is $40,000. You wouldn't have your account wouldn't have just gone down $40,000. It would have been the $40,000 plus the $100,000 loss plus the $10,000 loss plus the $10,000 loss, bringing it to $160,000 of pure value that would have gone bye-bye that 1 year. So what exactly are the ways? What exactly are the strategies to make sure that you're eliminating that? And that's something that we specialize in, and we show you ways on how to get that safe, consistent growth. If you're more towards your earlier years and you're looking to accumulate this on a tax-free manner, making sure that you're eliminating taxation, that you're getting your money in a tax-free manner, you're beating the pace of inflation, you're eliminating downward market losses, and you're further reducing your expenses that you would be accustomed to or would be subject to in kind of employee type retirement accounts such as a 401k, a 403b, a 457, a TSP, whatever that sort of plan is, or an IRA account. So there's so many different ways to skin that cat. Now, if you're that individual that says, I want to create a long-term financial plan on my retirement aspect, meaning my retirement income long-term plan, understanding that maybe I'm 65 years old and I feel as if I'm going to live for another 20, 25, 30 years, how exactly can I plan for that properly? That's an entirely different segment that we have specialists working with individuals on a daily basis. So because of all the companies that we represent every single company, throughout the U.S. Depending upon your area, depending upon your age, depending upon your specific goals, they're going to correlate to a specific need. So you want to make sure that what the person up the street, what maybe a family member might be saying, oh, talk to this guy, go with this plan, that might not be what's correct for your specific situation. You want to understand that you control all the chips in retirement, and on top of you controlling all the chips, you only have one shot to get things right. So there's zero room for error. At any point in time, call the 1-800 number. It's 1-800-566-1002. We implemented 24/7 customer service. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints, and it's because of our methodical process. On average, whenever you call in, we try to make sure that you're comfortable. We help dissect what's most important to you. Can you accomplish that goal of what's most important to you by what you're currently doing? If you can, then there's no need to change anything regarding your plans. Majority of the times that's not the case. Majority of the times there are some specific gaps, and regarding those gaps, it could easily be fixed with a specific financial product, and that's where we make the recommendations. It's not just something like we say, oh, we felt like this one company XYZ was a good idea, so just go with it. We're going through over 1,200 different strategies, product line scenarios, proprietary to our company. It's known as the Retire Sharp Planning System, RPS system, that we make sure that we go on average about 1,200 different products and scenarios per individual that calls in, making sure that when we give you recommendations, we say recommendation A, B, C. Here are the pros, the cons, pros, cons, pros, cons. This is what we recommend based upon your specific situation. And there is no room for error. You have to make sure that everything is done on a very safe, consistent way so that you have that confidence in retirement, so that when it does come time for retirement, you could spend it exactly what you've always hoped or you've always dreamed of. Once again, my name is Derek Afasi. I'm the owner of Afasi Financial Group. I want to thank you very much for watching this video. Please subscribe to our YouTube channel, Retire Sharp, so you have access to the most updated videos. Thanks, guys.